Hello everyone. We are continuing with our marginal costing topic. This is part 5, question number 7. A company gives the following information. Margin of safety in terms of value is rupees 3,75,000. Total cost is rupees 3,87,500. Margin of safety in terms of quantity is 15,000 units. Break-even sales in units is 5,000. We need to find selling price per unit, profit, PV ratio, break-even sales in rupees, and fixed cost. So to start with, already we have been given break-even sales in terms of, margin of safety in terms of value is given. So from that, we can say, we know quantity multiplied by selling price will give us the value. So here, margin of safety in terms of quantity is given, is known, multiplied by selling price. We have also been given as margin of safety in terms of value. So substituting the values, we will have 15,000 multiplied by the selling price will be margin of safety in terms of value, which is 375,000, which means our selling price will be 3,75,000 divided by 15,000, which will give us rupees 25 per unit. That is the first part. Then we can now do, since break-even sales is known to be, in quantity is known to be 5,000 units, we can do this fourth one. Break-even sales in terms of rupees will be break-even sales in terms of units multiplied by selling price. So that is 5,000 multiplied by rupees 25. That will give us the break-even sales as 1,25,000. Now we'll move on to the second part. We are supposed to find the profit. We know margin of safety in terms of value is equal to sales in terms of value minus the break-even point or break-even sales. So that means sales is equal to margin of safety plus break-even sales. That is, margin of safety in terms of value is 3,75,000 plus break-even sales. Just now we calculated it is 1,25,000. Together it becomes 5 lakhs. So our sale is 5 lakhs. So we have sales equal to rupees 5 lakhs. Then less total cost that is given in the question as 387,500 rupees. 387,500 will get the profit, the difference as rupees 112,500. We'll move on to the third part. Third part, we have to find PV ratio. Margin of safety is profit divided by PV ratio. That means 3,75,000 should be equal to 112,500 divided by PV ratio, which means our PV ratio is 112,500 divided by 375,000, which will give us 0.3, or we can say 30% is the PV ratio. Fourth part already we did. Now we'll move on to the fifth part where we have to find fixed cost. So break-even point is nothing but fixed cost divided by PV ratio. That means our fixed cost is break-even point multiplied by PV ratio, which is 125 000 multiplied by 0.3, which will give us rupees 37500. That is our fixed cost. So that will be the solution for this question. Let us move on to the next question. Question 8. Arnav Ltd manufacture and sell its product R9. The following figures have been collected from cost records for last year for the product R9. Elements of cost is given. Then variable cost portion is given. And then fixed cost is given. Wherein direct material is 30% of the COGS, direct labor is 15% of the COGS, factory overheads is 10% of the COGS, general and administration overheads is 2% of the COGS, selling and distribution overheads is 4% of the cost of sales. Fixed costs, they gave us for factory overheads 2,30,000, general and administration overheads, they gave us 71,000, selling and administration overheads, they gave us fixed cost as 68,000. So total fixed cost is 3,69,000. Last year, 5,000 units were sold at rupees 185 per unit. From the data given, find the following. We need to find break-even sales in rupees, profit earned during last year, margin of safety in terms of percentage, profit if the sales were 10% less than the actual sales. These are the things we need to find. First of all, 5,000 units were sold at rupees 185 per unit is given. So sales in value will be 5,000 multiplied by 185, which will give us rupees 925,000. So now we will assume the COGS as cost of goods sold as X. Now what is given here? Direct material is given, direct labor is given, factory overheads is given, general administration overheads are given. If I add all these things, I will get the cost of sales. So direct materials plus direct labor plus factory overheads plus general and administration overheads. If I add all this, I will get COGS. So now direct materials, we may see 0.3% of COGS, that is 0.3 times X, and then direct labor 15%, so 0.15 times X, and factory overheads 0.1 times X, plus fixed cost 2,30,000, plus general and administration overhead 0.0 times X, plus 71,000. Together, this will be COGS, which is nothing but X. So if we solve this, we will get X as 7x. Solving the above equation, we get X as 7 lakhs. So that is our COGS. Now let us assume the cost of sale as, let cost of sale equal to Y. So now cost of sale we can arrive by adding COGS plus selling and distribution expenses, overheads, will give us cost of sales. So this we know COGS is 7 lakhs plus selling and administration overheads is 4% of the cost of sales, 0.04 times Y, plus there is some fixed cost involved, 68,000. That should give us Y, which means 7,68,000 should be equal to 1 minus 0.04, we get 0.96 times Y. That means if I solve this, Y will be rupees 8 lakhs. That is our cost of sale. Now we have sales. Then we will calculate the variable cost. One is 30%. Sorry. Variable cost they gave us 30% of COGS. Let me put it like this. 30% plus we have 15% plus we have 10% plus we have 2% of COGS. That works out to 7 lakhs times together the percentage, if we add it is 45 plus 10, 55, 57, 0.57. Then variable cost, one more is there based on your COS, 4%. So 4% of COS, which will be 8 lakhs multiplied by 0.04. So together, if we calculate this, we will get 4 lakh 31,000. Sales is known to be 925,000. Let's say this is sales. So if we subtract these two, we will get the contribution will be 494,000. Then if we subtract fixed cost is 369, which we already available in the table, 369,000, we'll get the profit. So the profit will be 1,25,000. Now, what are all the questions? Well, first one is break-even sales. Break-even sales is fixed cost divided by PVR. That will be 369,000 divided by PVR. First, let us calculate PVR. PV ratio will be contribution by sales contribution we calculated here 494,000 divided by sale. Sale is 925,000. So that will give us 0.5341. That means our break-even sales will be 369,000 divided by 0.5341. That will give you rupees 690,882. Then next one, we need to calculate profit, which we already calculated. We have here rupees 1,25,000. Third, we have to calculate margin of safety in terms of percentage. First, we'll calculate margin of safety, which is sales minus break-even sales. That is 925,000 minus break-even sales is 698,882. If we subtract these two, we get 118. So margin of safety in terms of percentage is 234,118 divided by the total sale 925,000 multiplied by 100, we will get 25.3%. Then last question, last part of the question. Profit if the sales were 10% than the actual sales. Actual sales is 9,25,000. Then revised sale is 9,25,000. In this, 10% is going to get reduced. That means 90% will be considering. That will work out to 83,25,000. Now we have sales is equal to fixed cost plus profit divided by PV ratio. So which means 832,500 equal to fixed cost is 369,000 plus profit divided by PV ratio. We know it is 0.5341. That means our profit will be 8325,000 multiplied by 0.5341 minus 369,000. If we calculate that, we will get the profit as rupees 75,638. That will be the solution for this question.